Hello again and welcome to the second video that we've made for my new website, sextonreadsthecharts.com, and my name is Pat Sexton. So in this presentation I want to talk to you about the do's and don'ts of stock market investing. Now we'll start on a slightly negative note and we'll start with the don'ts. Because these are the traps that people tend to fall into when they start investing in the market for the first time. And indeed, they develop bad habits and they can stay doing these things for the rest of their investing career. And these are the things I wish someone told me about back about 25 or 30 years ago when I was first getting involved in the stock market. So here they are. The first don't, or be very wary of, is bargain hunting. Now the favorite strategy of almost everybody when they start investing in stocks is bargain hunting. If I rounded up 20 people there off the street at random, hunted them into an office, put them in front of a screen, told them all about the stock market, fundamental analysis, technical analysis, the whole goddamn thing, and left them off to their own devices, they had no excuses, they couldn't say their wife was calling, their child was sick or whatever, I bet you 90% of them would start with bargain hunting. People are obsessed with bargain hunting. They love bargain hunting. What is bargain hunting? A stock goes down 40% on bad news, and people make this incredibly arrogant assumption that the market has actually overreacted to this bad news and the stock has gone down too far and it's going to bounce back up. Well, I can tell you folks, I've been in the market now for 25 years. And that theory has mediocre results at best and completely disastrous results at worst. Now, what should you do? Okay, the company comes out with bad news, the stock price goes down 30 or 40%. Let's say they have a profits warning. What do? A better strategy I have found is hold back, wait until the stock begins to recover, wait until it looks like it has broken out of its downward trend and it is on the road to recovery, and that is a better time to buy. Bargain hunting, you buy one day too early and you can be down 30% in 24 hours. So bargain hunting is actually a very, very difficult strategy to execute in practice. The second mistake that I see people making time and time again is reacting to today's news. Now, if there is some good or bad news out about a particular company, it's priced in straight away. So it's too late. You've missed a train. If it's good news about a stock, there's no point in buying it. Ringing up your broker, going online, buying the stock. It's priced in. The big news on stocks is released when the market is shut. So forget about this idiotic idea that you can move quickly. The big news is out after the closing bell if it's a US stock, or before the market opens if it's a European stock. And the market makers will mark the price up or down accordingly. So reacting to news is a disaster. In fact, you'd be better off doing the opposite. If there's good news out, you'd be better off selling. If there's bad news out, well, you know my theory about bargain hunting. Be very, very careful about that. The third don't is being overconfident. You can't be too confident in this business. There's always something that could go wrong. You're trying to predict the future. Nobody can do that with 100% certainty. Being overconfident is a disaster. Invest less than what you really want to invest, is what I would say to you. The final thing that is deadly dangerous on the stock market is averaging down. You buy 1,000 shares at €10 a share, they go down to €7. What do a lot of people do? They buy another 1,000 shares at €7 and they now say, well, no, I've got my average down to, what's the halfway point between that? That's 8.50. Fine, you've got your break-even point down to a lower level, but you have also greatly increased your potential losses. And believe you me, those potential losses can become actual losses very, very quickly. So averaging down is a real mug's game. Now, I'll be more positive for the next part of the presentation, if we have time. What are the do's to actually make money? What should you do? The first thing that I wish somebody had told me 25 or 30 years ago when I was new to investing in stocks was to follow the trend. It sounds very easy. A lot of people won't do it. They say, oh, that stock is too high. Follow the trend. In fact, I would have no objection buying a stock if it has just gone to a new high. Why? that new high very often turns out to be a support level. It catapults up to a much higher trading range. It might come back to the old high, which acts as a support level, and it takes off from there. There are no stale bulls in that stock. Don't not buy a stock. Don't be put off from buying a stock, I should say, if it's at a new high, a recent new high. The good stocks are going to new highs every third or fourth month of the year. If you think about the success stories that we've had on the stock market. The second thing that I would say to you is buy the stock when it's not in the news. You always have a better chance of getting in there on the quiet. You don't want to buy the stock when it's in the news, because it's probably priced, then all the news is probably priced into the stock when it's actually in the news and every analyst all over the place is actually looking at it. The third thing I would say to you is be cautious, be careful out there, invest less than what you really want to invest. You think this is a really good stock, you've done the research, you've done the technical analysis, blah blah blah, you're thinking of investing €10,000, invest €5,000, right? The next point is average up. I'm a great believer in averaging up, totally against averaging down. You put in €5,000, it goes really, really well. 6 months later, the stock is traveling well. A year later, 2 years later, maybe you put in another 5,000, another 10,000, and you take a greater risk from a position of strength. It's the exact opposite of averaging down. Of course, what a lot of people do is they take their profit too early. Taking your profit too early is really bad news, because you will make 80% of your profits from about 20% of your stocks. So you don't want to sell those super stocks that you eventually get your hands on just by sheer persistence. The last thing I'll say to you is it is a superb discipline if you can cut losses. Now this is very, very difficult to do, but I learned a long time ago, and I do this with my own stocks. If I have a blue chip stock, large cap company, if it's down 15% on my purchase price, out. No questions asked. I don't care what is happening in the world, out. If it's a smaller company, if I'm down 30%, out. And I look back on my own trading record, and they were the best trades I did were when I cut losses early and I conserved a lot of my capital and moved it on into something else, because eventually you will find winners. So be persistent. They're my do's and don'ts, learned from hard experience after about 25 years. I hope you enjoyed this presentation. I hope I wasn't too negative. If you've seen this presentation on some other website other than my own website, please refer to www.sextonresearchcharts.com. I've got a lot of free stuff in there which I think will greatly assist you with stock market investing. Thank you.